Stay with me, because what happened between Friday afternoon and Saturday morning is the kind of thing that changes how you think about every position you're holding. We are going to cover 4 things today that have not been discussed anywhere in our previous videos. First, the weekly close and what the chart is technically communicating entering March. Second, the Commitments of Traders report that the CFTC released Friday afternoon, because the positioning data in that report is the most structurally bullish thing I have seen in this entire cycle, and almost nobody is talking about it correctly. Third, the $4.3 billion streaming deal that Wheaton Precious Metals just executed, which tells you more about where institutional money thinks silver is going than any price target. And fourth, the military strikes that the United States and Israel launched against Iran on Saturday, while every precious metals exchange in the world was closed, and what that means when COMEX reopened Sunday evening. Let us start with the weekly candle. Silver opened the week of February 23rd at approximately $86 to $88. It closed Friday, February 27th, at approximately $93 to $94. That is a weekly gain in the range of $7 to $8, or roughly 8 to 9%, on a metal that closed the prior week near 86. The intraday move on Friday alone was extraordinary. Silver came into the session around $89 and closed around $94. That $5 single-day move, layered on top of steady gains Monday through Thursday, produced a weekly candle that technical analysts are describing as a strong bullish continuation signal. Gold settled Friday at $5,247.90 on COMEX April futures, up approximately 1% on the day. The gold-silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold, compressed from approximately 58.5 on Thursday to approximately 56 to 57 at Friday's close. That ratio compression is a signal worth studying. When silver outperforms gold on a percentage basis, it typically indicates one of 2 things. Either speculative money is flooding into silver as the higher beta play, or the physical silver market is tightening faster than the gold market. Given what we know about COMEX registered inventory and the delivery data, the physical explanation is more consistent with the underlying evidence. The recovery arc since the early February low is remarkable. Silver hit a crash low near $70 when the CME raised margins in the first week of February and forced a violent liquidation. From $70 to $94 is a 34% recovery in under 3 weeks. That kind of V-shaped recovery does not happen in markets where the underlying thesis is broken. It happens when a price compression event removes weak hands, and then the structural buyers, the industrial purchasers, the delivery takers, the institutions converting eligible to registered, step back in at a price they consider attractive relative to what they know about physical availability. Key levels going into March. Resistance is at $100, a psychological round number that has never been traded in the modern silver market. Support was established at $83 during the margin-induced bounce and at the $70 crash low. The technical picture for the weekly chart is a hammer or bullish engulfing pattern depending on the specific open you use. Every major technical framework, Elliott wave, Fibonacci retracement levels, moving average alignment, points the same direction. The question is not the direction. The question is what catalysts accelerate or delay the move. Now I want to talk about the Commitments of Traders report, because the data in it is being misread by almost everyone commenting on it. The CFTC releases the COT report every Friday at 3:30 p.m. Eastern. It covers positions as of the prior Tuesday. The February 27th release covers positions as of Tuesday, February 24th. I want to walk you through what this report actually shows and why the specific combination of numbers in this week's report is structurally bullish in a way that is almost unprecedented for this stage of a price move. Managed money, which includes hedge funds, commodity trading advisors, and algorithmic funds, held approximately 22,260 net long contracts in the futures-only report as of February 24th. That number was down from roughly 24,000 the prior week. It is dramatically below the 44,987 net long contracts these same funds held in July 2025, when silver traded near $38. Now silver is trading at $94. Nearly 150% higher than July. And the managed money position is less than half of what it was at that lower price. This is not what a speculative bubble looks like. In a speculative bubble, managed money positions grow alongside prices as momentum traders pile in. What we are seeing instead is managed money getting progressively more cautious, liquidating longs, adding some shorts, while the physical market and the delivery data tell a completely different story. The implication is significant. When and if hedge funds decide this move is real and begin re-entering at scale, they will be buying into a market with depleted registered inventory and a 4-month swap rate inversion. The fuel for a speculative surge is fully loaded. The trigger has not been pulled yet. Total open interest in silver futures fell by 6,042 contracts to 125,454 on the futures-only basis. The combined futures and options open interest fell by 29,771 contracts, a 15% weekly decline, to 168,909. That is an enormous contraction of paper positions in a single week. Open interest falling while price rises is the signature of physical demand, replacing future speculation as the market's price-setting mechanism. Every contract closed without being replaced represents a futures participant who decided they no longer want paper exposure to silver and either took delivery or simply exited. The paper market is shrinking. The physical market is not. Commercial positions, the banks, miners, and dealers who traditionally run the large short side of the silver market, showed continued short covering. Commercial net shorts narrowed by approximately 1,267 contracts in the futures-only report to 41,080. On the combined futures and options basis, commercials reduced shorts by 8,338 contracts, while cutting longs by 6,476, net short reduction of approximately 1,862 contracts. The commercial short has fallen from 43,932 in September 2025 to 41,080 today. Banks are quietly reducing their structural short exposure to silver even as prices rise, the opposite of what they would do if they believed this was a speculative bubble they could lean against. The December 2025 Bank Participation Report, which covers the largest U.S. bank positions, showed something that has no recent historical precedent. U.S. banks went net long silver for the first time in memory. This means the entities historically responsible for capping silver prices through short selling have reversed their structural position. They are now net buyers. That structural shift is what gives every other bullish signal in the COT report its teeth. Small speculators, individual retail traders, and small funds below the reportable threshold were the only category adding to both sides of the market this week, increasing longs by 1,676 contracts and shorts by 1,200. For a net long increase to approximately 18,820. Retail is stepping in where institutions are stepping out. That dynamic has a name in commodity markets. It is called the distribution phase of a bull market, where smart institutional money sells to retail at a profit. Except in this case, the physical delivery data suggests the institutional money is not distributing paper to retail and quietly exiting. The delivery data shows institutions taking physical metal off the exchange in record quantities. What is being distributed to retail is the paper contract. The metal is going somewhere else. Now let us talk about Wheaton Precious Metals and what $4.3 billion actually communicates. On February 16th, Wheaton Precious Metals announced it was acquiring an additional silver stream on BHP's Antamina copper zinc mine in Peru for $4.3 billion. This is the largest streaming transaction ever by upfront consideration. I want to explain the mechanics because they matter. A silver stream is not a mining company investment. When Wheaton enters a streaming agreement, it pays an upfront amount to a mine operator in exchange for the right to purchase a fixed percentage of that mine's silver production at a predetermined low price, typically $10 to $15 per ounce, regardless of the market price. If silver goes to $150, Wheaton still buys at their contract price and pockets the difference. The streaming model is the single most efficient financial vehicle for expressing a long-term bullish thesis on silver without taking on operational mining risk. Wheaton's CEO, Randy Smallwood, said when announcing the deal, quality silver production is becoming increasingly difficult to source while demand continues to rise. That sentence, from the CEO of the world's largest silver streaming company, committing $4.3 billion of capital to lock up future production, is more valuable as market intelligence than any analyst price target. Wheaton does not make $4 billion bets on a hunch. Their financial models for this deal price out across decades. The present value math only works if their long-term silver price assumption is substantially above current spot. Given their contract purchase price and the transaction size, reverse engineering the model implies Wheaton is pricing silver in the range of $80 to $120 per ounce as a long-term baseline, not a peak assumption. The Antamina mine, located in the Peruvian Andes at 4,300 meters, is a joint venture owned by BHP, Glencore, Teck Resources, and Mitsubishi. It is one of the largest copper zinc mines in the world. Silver is a byproduct. Prior to this deal, Wheaton already held a stream on 33 1/3% of Antamina's silver. The new agreement brings that to 67.5% of all silver produced, covering essentially the entire recoverable silver output of one of South America's most productive base metal mines. The deal adds approximately 6 million ounces of silver per year to Wheaton's attributable production profile, financed through $1.9 billion cash a $1.5 billion term loan, and existing revolving credit. It closes around April 1st. To put $4.3 billion in context, that is roughly the value of all registered silver currently in COMEX vaults at current prices. One company just paid that amount to lock up future production from one mine. Meanwhile, the Kerr Mining and New Gold merger, a $7 billion transaction creating a producer of approximately 20 million silver equivalent ounces annually, is pending for the first half of 2026. And Lennar Royalties finalized a $670 million silver stream from the Fruta del Norte mine effective March 1st. These are not incremental deals. They are large institutions making multi-decade commitments to silver production at prices that assume the current bull market is structural, not cyclical. Before we get to what happened Saturday, I want to cover something that received almost no attention in silver media this week, but which tells you a great deal about the operational reality facing primary silver producers right now. Endeavour Silver reported fourth quarter and full year 2025 financial results on February 27th. Full year revenue came in at $467.5 million, up 115% year over year. That is not a rounding error. A primary silver producer more than doubled its annual revenue in a single year. But buried inside the earnings release was a disclosure that illustrates exactly what I mean when I say the supply side of this market is constrained in ways that price charts cannot fully capture. Endeavour Silver's Terronera mine, a new flagship project that only began commercial production in late 2025, was temporarily halted from February 22nd through February 25th due to, in the company's words, security events in the state of Jalisco, Mexico. Security events is corporate language for cartel activity. The mine resumed operations on February 26th. CEO Daniel Dixon described it on the call as a brief interruption and emphasized that operations are now fully normalized. The Jalisco situation is structurally unresolved. Mexico produces approximately 180 million ounces of silver per year, roughly 22% of global mine supply. Any production disruption in Jalisco, Zacatecas, or Chihuahua hits global supply directly. Endeavor's Terronera is a new mine, not yet at full production, currently targeting approximately 3 million ounces annually once fully ramped. A 4-day security halt at a mine this size costs approximately 33,000 ounces. Small in isolation. Multiplied across dozens of Mexican operations facing the same security environment, the cumulative supply impact is material. The Endeavour earnings report also revealed something useful about industry economics at current prices. With silver averaging approximately $70 to $80 for most of 2025, well below today's $94, a primary producer doubled its revenue. At $90 plus silver for a full year, the free cash flow generation across the sector would be transformational. Keith Neumeyer of First Majestic argued at a late February conference that silver mining equities are discounting silver at approximately $35 to $45 in their current valuations, meaning the stocks are priced as if the market will collapse back to prior lows, not as if $90 silver is a new baseline. If $90 silver holds for 2 or 3 quarters, earnings revisions will be violent and upward. There is one regulatory development this week that has received almost no coverage in silver-focused media, but which matters structurally for how this market gets overseen going forward. Bloomberg Law reported this week that the Department of Government Efficiency, DOGE, has revived internal discussions about merging the Securities and Exchange Commission with the Commodity Futures Trading Commission. This would be the most significant restructuring of American financial regulation since the Dodd-Frank Act of 2010. The CFTC is the regulator responsible for overseeing COMEX, enforcing position limits on silver futures, and investigating manipulation complaints. If the CFTC is absorbed into a larger, differently staffed agency during a period of peak stress in the silver delivery market, the regulatory oversight of exactly the market mechanics we have been documenting could be in transition precisely when it matters most. The CME February 25th trading halt, which still has received no public explanation beyond technical issues, has generated no CFTC inquiry, no SEC investigation, no congressional hearing request in public records as of this weekend. That regulatory silence becomes more significant, not less, if the agency responsible for investigating it is simultaneously facing a potential organizational merger. Now I need to tell you what happened on Saturday while the markets were closed. The United States and Israel launched coordinated military strikes against Iran on Saturday, February 28th. The targets included nuclear and military facilities in Tehran, Isfahan, Qom, Kermanshah, and Karaj. President Trump announced the action via Truth Social, describing it as massive and ongoing. Israel's defense minister described it as a preemptive strike to eliminate threats to the state. Iran retaliated within hours, striking U.S. military bases in the region, Israeli territory, and Gulf Arab state infrastructure, including targets in Dubai and Doha. The context that makes this geopolitically relevant is everything that happened in the 72 hours before the bombs fell. The third round of U.S.-Iran nuclear talks in Geneva concluded on February 26th without a deal. The United States demanded Iran destroy its Fordow, Natanz, and Isfahan nuclear facilities and surrender its 10,000-kilogram enriched uranium stockpile. Iran's Supreme National Security Council rejected these terms and said the U.S. must drop what they called excessive demands. NPR reported that U.S. envoys described the talks as productive before they collapsed. By Saturday morning, military action had replaced diplomacy. The last 3 times the U.S. was directly involved in Middle East military action: Gulf War in 1991, Iraq invasion in 2003, and the strike on Soleimani in January 2020. Gold gapped higher on the first trading session by between 1% and 4%. Silver followed with higher percentage moves in each case, but the precedent that is most relevant to the current setup is not any of those. It is August 1990 when Iraq invaded Kuwait and the Gulf War began. In August 1990, gold moved from $360 to $412 in the 3 weeks following the Kuwait invasion, a 14% move in under a month. Silver moved from $4 to $5 over the same period, a 25% gain. The setup then has notable similarities to now, an already elevated precious metals market, a hot inflation environment following the late 1980s credit expansion, and an oil supply shock threatening to push inflation higher. The difference is that in 1990, silver was at $4 and had significant room below it. Today, silver is at $94, and the physical delivery data suggests there is very little room below current prices because the structural buyers, industrial users, with no paper substitute, are continuously entering the market at any level below their production cost calculations. The Iran scenario introduces an oil supply shock angle that the January 20th, 2020 Soleimani strike also contained, but never fully triggered, because Iran chose not to escalate at that moment. Iran did not de-escalate this time. They retaliated within hours. The oil price mechanism matters for silver not only because oil is an input cost for mining, but because an oil price spike of 20 to 30% would push the U.S. CPI and PCE prints significantly higher, which further removes rate cut probability from the Fed's forward guidance, which further validates the stagflationary thesis that is already driving precious metals allocation by institutional money managers. Copper's price, at $5.97 to $6.14 per pound, near its all-time record, is worth noting in this context. Copper and silver have extensive physical overlap. Both are produced as byproducts of base metal mining. Both have critical industrial applications in electrification and energy transition. And both are subject to the same China export control risks. A copper market trading at record prices simultaneously with silver at $94 is telling you that the industrial metals complex as a whole is pricing in a supply-constrained world. This is not a rotation from one metal to another. It is a repricing of the entire physical commodities complex relative to fiat currency denominations that are being debased simultaneously across every major economy. The Strait of Hormuz, the 21-mile wide waterway between Iran and Oman, through which approximately 20% of global oil supply flows, is now effectively within a war zone. Over $500 billion in energy trade transits the strait annually. Iranian military doctrine includes mining the strait and using its coastal missile batteries against tankers in the event of conflict. None of that has been activated yet, but the threat alone is sufficient to move energy and precious metals markets dramatically. Gold was already above $5,200 before the first strike. Silver was near $94. The historical pattern after Middle East military escalations of this scale is consistent. Gold gaps 3 to 5% higher on the first trading session. Silver moves in the same direction with higher beta. When COMEX electronic trading opens Sunday evening Eastern Time, the market must simultaneously reprice for an active military conflict involving a nuclear program, for the hottest PPI reading in over a year from Friday, for the most compressed gold-silver ratio in years, and for a physical silver delivery month that began with 61% of registered inventory already claimed. The last 3 times the U.S. was directly involved in Middle East military action, Gulf War in 1991, Iraq invasion in 2003, and the strike on Soleimani in 2020, gold gapped higher on the first trading session by between 1% and 4%. Silver followed with higher percentage moves in each case. In 2020, following the Soleimani strike, silver moved from $17 to $19 in the subsequent 10 days, an 11% move, before broader COVID volatility overwhelmed the signal. The current setup has multiple overlapping drivers that were absent in those prior episodes. The Pakistan-Afghanistan conflict, which entered its 3rd consecutive day of fighting on Saturday, adds a second simultaneous geopolitical shock. Pakistan's spokesperson declared no dialogue and no negotiation as Taliban drone strikes hit military camps in Banu. Qatar began mediation efforts but has made no announced progress. The silver supply chain connection. Pakistan is a significant market for silver jewelry and industrial silver products, and Afghan transit routes matter for certain Central Asian mining outputs, is secondary to the simple safe haven demand signal that two concurrent wars provide. Let me now address something that is being discussed in the broader financial community this weekend that connects to silver in ways that are not immediately obvious. The Supreme Court struck down the Trump administration's IEEPA tariffs on February 20th in a 6-3 decision. The administration immediately reimposed tariffs under a different legal authority, Section 122, the same statutory tool Richard Nixon used in 1971 when he closed the gold window and imposed a 10% import surcharge simultaneously. The White House fact sheet on the new tariffs explicitly exempts certain critical minerals and metals used in currency and bullion. Silver bullion appears to fall within that exemption. But the tariff context matters for silver through a second mechanism. The tariff chaos has driven a scramble for physical precious metals into U.S. vaults, specifically to avoid any uncertainty about whether tariffs might apply to future imports. When U.S. institutions fear that silver imported in 3 months might carry a tariff they cannot currently price, they buy today and take delivery today. That behavioral pattern is part of what explains the record delivery volumes in January and February, and the vault mobilization we documented in the February 27th depository report. Separately, Treasury Secretary Scott Bessent made remarks in early February blaming Chinese traders for silver's volatility, an attribution that sits awkwardly alongside a Wall Street Journal profile describing Bessent as a self-described gold bug who considers gold the ultimate currency. Multiple pieces of congressional legislation are circulating to revalue the Federal Reserve's gold holdings from the statutory $42.22 per ounce to market value, which at current prices would generate between $760 billion and over $1 trillion in fresh Treasury capacity. If gold is formally revalued, the silver price implications depend on whether the gold-silver ratio compresses or holds. At current ratio levels near 56, a gold revaluation to $5,500 implies silver at approximately $98. That is where the market currently sits, organically, without any formal revaluation having occurred. The retail market data adds another dimension this week. The Perth Mint reported January 2026 silver coin and bar sales of 1,722,639 ounces, up 315% from January 2025 and up 188% from December, the highest monthly total since May 2023. The U. S-Mint launched the 2026 West Point Proof Silver Eagle on February 26th, priced at $173 each with a 500,000 unit mintage. Pre-orders had already reached 209,027 units before the official launch date, over 40% of the total available supply committed before the product was technically on sale. The coin features dual dates commemorating the United States semi-quincentennial and a Liberty Bell privy mark. Earlier in February, the U.S. Mint reported that 2026 bullion silver eagles are already listed as currently unavailable on its website, a supply constraint with no modern precedent this early in a calendar year. Online dealer premiums for silver coins range from 15 to 25% above spot. The exchange for physical spread, the premium paid to convert a futures contract into physical metal for immediate delivery, expanded from its historical average of 25 cents per ounce to over $1.10. Silver lease rates sat at approximately 8% annualized versus a normal range of 0.3% to 0.5%. Refiner backlogs for 1,000-ounce bars persist as industrial and investment demand simultaneously exceed processing capacity. The ETF flow data completes the picture. Approximately $1.2 billion in net inflows entered SLV during the 5 trading days ending February 27th, following a massive $3.4 billion single-day inflow earlier in February that represented the largest daily inflow in the fund's history. Aggregate global silver ETF holdings fell to 815 million ounces on February 23rd, before recovering sharply to 834 million ounces by February 25th, an 18.84 million ounce swing in 48 hours. Sprott Asset Management doubled its at-the-market equity program for PSLV to $2 billion on January 20th, enabling the acquisition of approximately 18 million additional ounces of physical silver at the Royal Canadian Mint. PSLV's structure matters. Unlike SLV, PSLV's silver cannot be hypothecated or lent. Every ounce that flows into PSLV is physically allocated and removed from the lending market permanently. Let me talk about what the broader metals complex is telling us, because the week ending February 27th was not a silver story alone. Platinum surged to between $2,362 and $2,382, up 3 to 4% on Friday. Palladium held at $1,770 to $1,810. Copper traded at $5.97 to $6.14 per pound, near record territory. All four metals rising together in a single session is the signature of macro-driven repricing. It means the move is being powered by falling real yields, dollar weakness, geopolitical risk, and stagflationary data, not by commodity-specific news alone. When you see silver, gold, platinum, palladium, and copper all moving together, the denominator is changing, not just the numerator. The dollar's purchasing power is being reassessed in real time. Bitcoin, by contrast, fell to $65,500, down 3.2% in 24 hours, extending its decline from $83,000 in late January. The divergence between rising hard assets and falling crypto is a classic flight to quality rotation. In 2021, Bitcoin and silver moved together as retail investors treated both as inflation hedges. The decoupling in 2026 suggests institutional positioning is driving the precious metals move rather than retail speculation, which is consistent with the COT data showing hedge funds still underweight and delivery data showing physical institutions as the buyers. There is one more data point I want to leave you with before we close, and it is the one that most clearly frames what happens next. The Sprott Asset Management CEO John Ciampaglia described the silver rally this week at PDAC 2026 as a catch-up trade rooted in years of supply deficits. Eric Sprott himself, in an interview published Friday by Kitco, gave a price target of $300 for silver. That is more than 3 times the current price. The last time Eric Sprott put a number that high on silver publicly, it was in 2020 when silver was trading at $17. It subsequently reached $49.80 in less than 18 months. Whether $300 is right or wrong, it is the number Sprott is committing to publicly after decades of watching precious metal cycles. It deserves to be taken seriously as a data point, even if you disagree with the specific figure. The underlying logic is not complicated. If silver's real price is determined by the physical market rather than the paper market, and if the paper-to-physical ratio is currently estimated at 356 to 1, then any significant reversion toward physical reality implies multiples of the current price. The COT data shows the speculative fuel is not yet spent. The delivery data shows the physical demand is not slowing. The Iran strikes show the geopolitical premium is only beginning. The Wheaton deal shows the smart institutional money is locking in production for the next 2 decades at implied prices that are meaningfully higher than today. Endeavor. Silver's 115% revenue surge shows what happens to producers when the metal price corrects the market's prior mispricing. And the Doge-driven CFTC restructuring shows that the regulatory framework overseeing all of it is in flux at the worst possible time. When COMEX opens Sunday evening, none of that changes. What changes is the price. Currency Archive. Subscribe if you're not already subscribed. Like this video if the analysis added something real to your understanding. Come back Monday, because the COMEX opens Sunday evening directly into an active war in the Middle East, and March has 31 delivery days remaining. The story we are documenting is not finished. It is accelerating. Every day that the physical data diverges from the mainstream narrative is another day this channel exists to show you the difference.